deferred tax asset and deferred tax liability sources. Again, the deferred taxes may be a liability or asset. The liability is because they arise due to net taxable amounts in the future. Deferred tax asset arise due to net deductible amounts in the future. Again, think about it. Have you prepaid or are you going to owe later on? That's the whole big difference here.
Here is a slide that I want you to screenshot or keep near with you as you're doing questions related to deferred tax assets and liabilities. This is a pretty solid formula and way to remember and understand when you have liabilities and assets. If your taxable income is less than your financial statement GAAP income, you have a deferred tax liability. And vice versa, if your taxable income is greater than your financial statement book income, you have a deferred tax asset. I'm going to read these statements. I wrote these, and I want you to read them yourself over and over. Keep them next to you when you're approaching questions on deferred tax assets and liabilities. That way you can, like without examples, it's hard to grasp, but this should sincerely help you understand the differences and when you have each. Now, when taxable income, so that income on your tax return is less than GAAP, I almost said GAAP or book income, a deferred tax liability is created. This is because less tax would have been paid in this period because there was less income, then was reported on the financial statements as income tax expense. And it will have to be paid in the future, thus incurring a liability, a deferred tax liability. Similarly, when taxable income is greater than GAAP or book income, a deferred tax asset is created. This is because more tax would have been paid in this period than was reported on the financial statements as income tax expense. And it will not have to be paid in the future, thus incurring an asset. Again, super important here, understanding the differences and when to recognize each. This is something that trips up a lot of people, and I'm doing my best here. Make sure that does not happen to you.
Recording a valuation allowance for doubtful deferred tax assets. So if a deferred tax asset seems doubtful, then we use a valuation allowance account to record it. This is the journal entry to basically reduce. It's like impairing an asset, right? This is similar to that sort of process where the journal entry here is you're going to debit income tax expense and credit allowance to reduce deferred tax asset to its expected realizable value. You're writing down basically a prepaid tax benefit, right? So this is if you're recognizing that, hey, you're not going to be able to realize that asset.